Hey, you. Are you looking to get rich? Trying to escape the vicious cycle of financial struggle, searching for the freedom that money can bring? Gold? Stocks? Real estate? Or maybe crypto, the market that's making waves, with stories of 10x or even 100x returns happening as easily as flipping a switch? Hold on a second. Before you pour all your savings or even borrow money to go all in on some market just because of a hot tip, someone flaunting their gains, or your fear of missing out, hear me out. Welcome to Pie From Us. I've been grinding in this tough financial battlefield for a full 10 years now. A decade, maybe not a lifetime, but long enough to experience the full range of emotions. The euphoric highs of hitting big profits, sometimes in the hundreds of thousands of dollars, and the crushing lows, bitter disappointments, and brutal lessons learned from losing significant sums. Mistakes that cost me dearly. I'm not here today to brag about my achievements or paint some rosy picture of getting rich quickly. Let me say this loud and clear. That does not exist. If anyone tells you otherwise, be cautious. But what I am here for is to share what I've genuinely learned over these 10 years. The principles, experiences, and hard-earned lessons that I believe can help you, those who are just starting out or still struggling on their investment journey, save a lot of time, money, and heartache. Maybe even 5 to 10 years of fumbling around and paying the price like I did. In today's video, we'll break down the core questions that every investor eventually faces. 1. Where is the real gold mine? Which market will actually help you build wealth? The answer might surprise you. 2. What knowledge do you need to survive? How can you avoid scams and losing money before you've even made your first profit? 3. The core investment formula. After 10 years, what's the approach I value most? The one that's brought me the most sustainable returns? 4. The non-negotiable conditions. This is the most important part, the elements you must have in order to successfully apply the above formula and achieve long-term success. Watch this video closely. Don't skip a single part, especially the ending. Those final principles are unshakable truths, the guiding compass you must follow if you're serious about surviving, thriving, and building wealth in any investment field. Trust me, it's worth every minute of your time. Chapter 1. Which market will make you rich? The sweet trap of choice. All right, let's start with the question I'm sure everyone's asked themselves at least once. What should I invest in to get rich? Open a newspaper, scroll through social media, and you'll see sensational headlines everywhere. Mr. A made a fortune with stock XYZ. Ms. B doubled her account by catching the bottom in gold. Or, more dramatically, a young guy becomes a dollar millionaire overnight, thanks to some obscure meme coin with a name you can barely pronounce. Are those stories real? Yes, absolutely. There are people who pulled that off. But here's the catch. It's just like hearing someone won the lottery for tens or hundreds of billions of dong, or millions of dollars. It happens, but the odds of that person being you are incredibly, incredibly low. Those stories prey on your greed and trigger a dangerous emotional state in investing. FOMO, fear of missing out. It makes us feel like if we don't jump into that hot market right now, we'll miss our one and only train to wealth. We delude ourselves into thinking we could be the next lucky one. And here's the harsh truth. I had to painfully learn after losing a lot of money and wasting the first 5 years of my career to realize no market will make you rich on its own. Listen carefully. Gold, stocks, real estate, crypto, forex, bonds, all of them. They're just tools. They're not good or bad. They don't make you rich, and they don't make you poor. Imagine you're a carpenter. You've got all kinds of tools, saws, chisels, planes, sandpaper. But can a high-quality saw create a beautiful table by itself? Of course not. It's your skills, knowledge, experience, and how you use those tools that determine the final result. Just like a knife, you can use it to peel fruit, slice meat, and do all sorts of useful things. But that same knife, in the hands of someone with bad intentions, can become a weapon. The blame lies with the user, not the knife. Financial markets are exactly the same. How you use these tools, markets, is what really matters. Simply realizing this one truth can save you at least 5 years of chasing after so-called golden opportunities and fantasy open-pit gold mines out there. So, What's the practical advice from someone with 10 years of experience ahead of you? Very simple. Pick one market that you feel most comfortable with and spend your time digging deep, truly learning about it. Don't be greedy. Don't try to become an expert in every single field. You can't be a top tier stock analyst, a savvy real estate veteran, and a crypto whale all at once, especially when you're just starting out with limited capital and little experience. Focus creates power. This principle is incredibly simple, but always true. Think of a nail. Why can it pierce through hard wood? Because all the force is concentrated on one sharp point. If the tip is dull or flattened, the force gets scattered, and no matter how hard you hammer, it won't go in. Investing is the same. Focus your mind, time, and resources on one area first. Once you're truly good at it, once you understand a market inside and out, you can absolutely make a lot of money from that single market alone. So which market should you choose? Use the following practical criteria. 1. Convenience. Is the market easy for you to access and trade in? Is the platform user-friendly? Can you monitor and manage your investments easily? 2. Safety. Is the trading method secure? Is your money protected? Are there any mechanisms in place to safeguard investors? 3. Legality. This is extremely important. Is the market legally recognized and protected by law? Are there clear legal frameworks in place? Investing in markets with unclear legal status is very risky. You could lose your money and even face legal trouble. Always prioritize legal, state-regulated markets. That's the best way to protect yourself and your assets. Let's look at some real-world examples. Stocks, securities, clear legal framework, securities law, regulated by the State Securities Commission. Trading is fairly convenient via brokerage firms and online platforms. Suitable for many people, including beginners and salaried workers. You don't need a large starting capital. Real estate, covered by land law and real estate business law, etc., requires large capital, lower liquidity, and very careful legal research on each project and location. Best suited for those with significant funds, long-term vision, and in-depth knowledge of local markets. Gold, a relatively safe haven, familiar to the public. Physical gold is easy to trade. However, the price doesn't usually spike dramatically like other channels and is influenced by regulatory policy. Cryptocurrencies. Extremely high profit potential, but also extremely high risk. Most importantly, the legal framework for this asset class is still unclear. This is a major risk factor you must take seriously. To make it easier for you to visualize, I've prepared a basic comparison table of these popular markets. Take the time to seriously reflect on your personal circumstances, your risk appetite, how much time and knowledge you can realistically invest, and choose one playing field that suits you best at this stage. Don't rush. Picking the right field is a crucial first step. Once you've made that decision, we move on to the next part. What knowledge do you need to equip yourself with to avoid being kicked out of the game right from the start? Chapter 2. 3 Foundational Survival Skills. Build the foundation before building the house. All right, you've identified your battlefield, and now your mindset is probably something like this. You're excited to find out how to make money right away, right? What should I buy? When should I sell? How do I double or triple my account quickly? Hold on. That's a fatal mistake that 90% of newcomers make. It's just like building a house. You can't build the second floor if you haven't even laid the foundation. In investing, the first and most solid foundation you need isn't about how to make money. It's about how to not lose money foolishly. Believe me, in this game, keeping your money is actually harder than making it. Foundational knowledge number 1, identify and avoid scams. The world of finance, especially online, is full of scammers, using all kinds of tricks from the simple to the shockingly sophisticated. Their tactics constantly evolve, but their core strategy remains the same. They prey on your greed and lack of knowledge. Burn this golden rule into your brain. There is no such thing as a free lunch. You will never be able to make money easily and quickly without putting in knowledge, effort, or accepting equivalent risk. So, how can you spot a scam? Here are the red flags you must be absolutely alert to. Unrealistic profit promises. Anyone or any project that guarantees absurdly high fixed returns, e.g. 20%, 30%, 50% a month, or even several percent per day, is 99.99% a scam. No real market delivers steady, sky-high returns like that in a sustainable way. Promises of zero risk or guaranteed no loss. All investments come with risk. Anyone who says otherwise is lying to you. Disguised pyramid schemes. These lure people in by promising huge commissions for bringing in new recruits, instead of focusing on the actual value of the product or service, if any. Money from new investors is used to pay old ones, and collapse is only a matter of time. Shady investment delegation schemes. You give your money to a so-called expert or investment fund with no license or credibility to invest on your behalf and share the profits with you. The risk? They run off with your money, and you never hear from them again. Fake flashy lifestyles, showing off luxury cars, fancy houses, and glamorous lives to lure you in and make success seem effortless. High-pressure sales tactics. They don't give you time to think or research, always pushing limited spots, last chance, or almost sold-out narratives. Always ask yourself, if making money was really this easy, why are they sharing it with you? Why don't they just quietly raise funds from family and friends, or just keep it to themselves? Don't think only the uneducated get scammed. Even experienced, wealthy individuals can fall victim if they're careless, let their guard down, or let greed cloud their judgment. This lesson can be extremely costly. It can wipe out your entire life savings in the blink of an eye. Always stay alert and question anything that sounds too good to be true. Foundational knowledge number 2, do thorough research. Choose the right quality asset. Once you've learned how to avoid scams and worthless investments, the next step is learning how to identify and select quality assets, those with real value and sustainable growth potential. If you want to earn money consistently and long-term, you need to look for where the crowd is, places with recognized value, good liquidity, and proven credibility. Forget the gambling mindset, buying penny stocks or trash coins priced at $0.1, hoping they'll go 100x or 1000x someday. Is it possible? Technically, yes. But is it likely? The odds are worse than winning the lottery. That's not investing. That's blind gambling with an extremely low chance of success. Don't waste your time and money on those things. Instead, focus on the industry giants, the market leaders, well-established companies in the sector you chose back in Chapter 1. And most importantly, choose a sector you already understand or can easily learn about. For example, if you work in banking and you understand credit and capital mobilization, focus on researching bank stocks. If you're familiar with the retail market, study companies within that sector. Choosing a field where you have informational advantages or can easily gain insight will help you make more accurate investment decisions. So what exactly should you research about these big players? 1. Company history and development. How long has the company been around? Has its growth been stable and consistent? 2. Core product services. What do they actually sell or provide? Is there a real, high, sustainable demand for it? 3. Competitive advantage. What sets them apart from their competitors? Strong brand, superior technology, wide distribution network, low costs, etc. 4. Basic financials. At the very least, review their revenue, profit, and debt levels from the last 3 to 5 years. Is the business growing? Is the growth stable? Is the company financially healthy? Understanding financials won't guarantee profits, but it will significantly reduce your risks. 5. Leadership team. This is an extremely important factor that's often overlooked. Who is steering the company? Do they have vision and integrity? Do they have a clean track record? Have they ever been involved in scandals, fraud, stock price manipulation, or shady business practices? Does the company transparently disclose information? Remember, this is your money, the result of your hard work and sweat. Don't throw it into places you don't fully understand, or worse, into companies led by dubious or unethical management. Choose wisely. Invest in businesses with solid foundations, transparent operations, and leadership that combines competence with integrity. Ashta foundational knowledge number 3. Understanding price history, seeing the story behind the numbers. This is the part I know many people, especially beginners, tend to dread the most. Staring at complex price charts filled with red and green lines and cold numbers constantly dancing around. But I have to say this, If you want to go far in investing, you must learn how to get familiar with and interpret these charts. Looking at a price chart isn't just about checking how much a price has gone up or down today. That's just the surface. What you really need to uncover is the story behind the price movements. You must be able to answer questions like, why did the price go up? Why did the price drop? Build the habit of connecting historical price fluctuations with macroeconomic events, interest rates, inflation, GDP growth, monetary policies, political developments, elections, wars, geopolitical tensions. Company-specific news, strong weak earnings reports, new product launches, leadership changes, scandals, or even market psychology, panic, euphoria. When you understand the causes behind past movements, you'll develop deeper insight into the personality of the market, what actually drives price changes. History never repeats itself exactly, but it often rhymes. Economic cycles and emotional market cycles, greed, fear, tend to repeat over time. Understanding history helps you assess current price levels. Compared to historical data, is the price now relatively cheap or expensive? Are we at the top or bottom of a cycle? Spot opportunities and risks. When similar events occur, you can, though not with certainty, anticipate how the market might react based on past behavior. Gain long-term perspective. Realizing that markets naturally move in cycles helps you stay calm during short-term volatility. Don't just look at the price chart of a single asset. Compare it with others in the same sector, with overall market indexes, or even with global markets. This kind of comparison gives you context, helping you evaluate whether the asset is performing better or worse than the broader market. Mastering these three foundational skills, avoiding scams, researching quality assets, and understanding price history, is like building a solid foundation for your investing house. Only once you have this foundation in place can we confidently move on to the next level, the formula for actually making money. Chapter 3, the core investment formula. After 10 years, simple but not easy. All right, we've gone through the defensive part, how to avoid losing money. Now comes the offensive part, how to actually make money, potentially a lot of money, in a sustainable way. That's undoubtedly what we all aim for when stepping into the financial markets, right? When I first started, I imagined making money from investing would be super cool. I thought I would learn some kind of legendary technical analysis techniques, sit in front of a screen with dozens of complex charts, and just casually place trades, making a few hundred, even thousands of dollars a day, like in those flashy Hollywood Wall Street movies. I dove into everything. RSI, MACD, Bollinger Bands, Ichimoku, Elliott Waves. I read piles of books, joined all sorts of courses, and tried to uncover a holy grail, a secret formula that would let me perfectly catch the bottom and sell at the top, predicting market moves with precision. And guess what the result was? Me, 10 years ago, failed miserably with that approach. Sure, there were moments of success. I made quick profits and felt like a genius. But most of the time, I lost money, cut losses repeatedly, and even worse, I was constantly stressed out, couldn't eat or sleep properly because I had to monitor price boards every minute, every second. The financial market is inherently chaotic and influenced by countless factors, including irrational herd psychology. There is no mathematical formula or technical indicator that can guarantee constant wins, especially when it comes to short-term trading. After many failures and paying a hefty tuition to the market, I finally came to realize and confirm a core investment formula, a method that has helped me make the most money and, more importantly, allowed me to invest with greater peace of mind and long-term sustainability. This formula might sound boringly simple, but if you truly understand it and apply it correctly, it is extremely powerful. Here it is. Buy the right quality asset at a cheap price, the cheaper the better, during times of market panic, and buy with a large enough position. Sound familiar? Maybe you've heard about value investing, the philosophy of Warren Buffett. That's right, this isn't some revolutionary concept I invented, but the point is not whether you've heard of it, it's whether you deeply understand it and can actually do it. Let's break down each element of this formula. 1. Right quality asset. This is the result of what you learned in Chapter 2. These are stocks of leading companies with solid business fundamentals, sustainable competitive advantages, trustworthy leadership, and healthy financials. Or it could be real estate in prime locations with clear legal status, or physical gold as a safe haven asset. Do not apply this formula to speculative assets with no intrinsic value, like penny stocks or junk coins. If you buy those during a market crash, chances are they'll crash for good and never recover. 2. Cheap price. Cheap doesn't mean low nominal price, like $1 share. Cheap means cheap relative to the asset's intrinsic value. How do you determine intrinsic value? That's a whole process of analysis and valuation. We'll go deeper into that in another video. But here's a simpler way to sense if something is cheap. When the market price of a good quality asset drops sharply and unusually, far below its historical average or long-term growth potential, often triggered by external events or negative market sentiment. 3. The right timing, when the market panics. This is the golden moment to buy quality assets at cheap prices. When does that happen? During economic crises, widespread pandemics, outbreaks of war, or when extremely negative news floods the media. It's when fear grips everyone and people start panic selling their assets at any price without caring about their intrinsic value anymore. It's the very panic of the crowd that creates these super discounts on high-quality assets. Remember when President Donald Trump announced new retaliatory tariffs? The stock market went into freefall. Even high-quality stocks dropped 30 to 50% or more. That was a moment of market panic. 4. A large enough position. This factor determines your final outcome. If you only invest $100 and the asset doubles in price, 100% return, you've only made $100. That's not going to change your life. But if you have $100,000 to invest in the same asset and it increases by just 30%, you've made $30,000. See the difference? To generate meaningful profits and truly change your financial situation, you need to have enough capital to invest when golden opportunities arise. That's why capital accumulation is so important. We'll dive deeper into that in the next chapter. So once you've bought in, then what? Just hold forever? Not necessarily. This formula requires one more element. You must know when to sell in order to realize your profits. So when should you sell? The opposite of when you bought. Sell when the market becomes too euphoric, when greed reaches its peak. That's when everyone around you is talking about investing. People are bragging about their gains. Experts on TV are shouting that prices will go to the moon, and companies are rushing to IPO at sky-high valuations. These are signs that the market is overheating and that asset valuations have become unreasonably expensive compared to their real worth. At that point, selling isn't about fear of a drop. It's about locking in your profits and preparing cash for the next cycle. So the loop of sustainable investing looks like this. Accumulate capital, patiently wait for market panic, buy quality assets at low prices with a large position. Patiently wait for recovery and euphoria. Sell and take profit. Hold cash. Repeat from accumulate and wait. This is the exact formula and path I've personally followed and tested over the past 10 years. I've tried many other strategies, short-term trading, chasing rumors, using high leverage, but in the end, this method is what allowed me to make the most money in a sustainable and stress-free way. And I truly believe that if you understand and apply it correctly, it will help you achieve similar success. However, saying it is always easier than doing it. To successfully execute this seemingly simple formula, you need a few critical ingredients that most people either lack or fail to develop. That's the topic of the final chapter. The chapter that separates successful investors from those who fail in the financial markets. Don't miss it. Chapter 4. The necessary and sufficient conditions for success, the golden key you must hold. We already have the map, foundational knowledge, and we already have the vehicle, the core investment formula. So why is it that 80 to 90% of investors still lose money in the market? Why is it that we know we should buy when others are fearful and sell when others are greedy, but when the moment comes, we can't do it? The answer lies here. They lack the following necessary and sufficient conditions. These aren't complex skills, but they require discipline, inner strength, and a solid foundation. In my view, these three conditions determine 80% of a long-term investor's success. while formulas and knowledge only make up the remaining 20%. Critical condition number one, you must have a job that provides a stable monthly income. Sounds a bit disappointing, doesn't it? Maybe you're imagining a future where you quit your boring job, sit at home clicking buy and sell buttons, and watch money roll in without lifting a finger. I hate to burst your bubble, but that's not going to happen. At least not in the beginning, and for most people, maybe never. So why is having a stable job so important? Because of two key reasons: capital and psychology. Capital. As mentioned in Chapter 3, your capital size is crucial to generating meaningful profits. Where will your investment capital come from if you're not working? Your job is the source of steady cash flow, allowing you to accumulate capital over time. You must regularly set aside part of your monthly income, whatever you can, 10, 20%, 30%, or more, to build up your investment fund. This money must be disposable income, meaning that even if you lose it, which of course we don't want, it won't critically affect your daily life or your family's basic needs: food, rent, children's education, etc. This is about first establishing personal financial security. Psychology. Now, this is the real game changer. Psychology is the Achilles heel of all investors. You could have deep knowledge and the perfect strategy, but if your mindset is weak, you'll never make the right decisions at crucial moments. Imagine this: the market crashes by 30%, and the great stock you're holding has dropped 30% too. Scenario 1. All your money is in that investment. You have no other income. How would you feel? Panic. You're terrified it'll keep falling. You fear losing everything. The psychological pressure is overwhelming. You end up selling at a loss, even if deep down you know it might be the bottom and a buying opportunity. Scenario 2. That investment is only a portion of your disposable savings. You still have a stable job. Your salary still arrives monthly, covering your needs. Sure, you're a bit upset that your assets have dropped, but you're far more calm and rational. You know the company is still solid. This is just market panic. In fact, because you'll get paid again next month, you now have both the courage and the resources to buy more while prices are still cheap. See the difference? A stable job is your strongest psychological buffer. It helps you ride out market storms and gives you the confidence to act against the crowd, to buy when others are afraid. So my sincere advice: never, ever think about quitting your job to go full-time trading or full-time investing unless you've already built a large, stable stream of passive income, e.g. rental income, consistent dividends. Or you already possess a huge amount of capital, enough that the interest or returns from it can support your lifestyle comfortably. Doing the opposite is putting yourself in extreme financial danger, a form of financial suicide. Keep your job, do it well, and treat investing as a long-term wealth-building vehicle, running in parallel with your main job. Condition number 2, you must have extraordinary patience. If you think investing is a get-rich-quick path, buying today, selling tomorrow, and instantly making a profit, then you're seriously mistaken again. The investment formula I shared is a long-term game that requires astonishing levels of patience. Patience to wait for the right buying opportunity, opportunities to buy quality assets at dirt-cheap prices when the market is in panic, don't come around every day, week, or even month. Sometimes you may have to wait 1, 2, or even 3 to 5 years for a strong enough correction or a real crisis that creates such bargains. What should you do during that waiting period? Sit around doing nothing? Absolutely not. You should keep doing well in your main job, condition number 1, and continue accumulating capital consistently. Just as important, you must keep researching, stay informed, and closely monitor the potential targets you've identified. Just 3 to 5 quality targets are enough. No need to track too many. Be fully prepared so that when the opportunity arrives, you know exactly what to buy. Patience when the market moves sideways or not as expected. There will be boring periods when the market drifts sideways for an entire year. Or you may have entered a little too early and prices continue to fall. In these moments, you must stay patient. Don't get restless and don't FOMO into other hot speculative trends. Trust in your choice and your analysis if you've done your homework thoroughly in Chapter 2. Patience to wait for the right selling moment. After you've bought quality assets at a great price, you also need to patiently wait for the market to recover and enter a phase of euphoria. This process could take 1 year, 2 years, 3 years, or longer. Don't rush to harvest early just because you've made 10 to 20%. If you bought the right asset at the right time, give it time to reach its full growth potential. Time is the value investor's best friend. Patience is an extremely difficult trait to develop in our fast-paced, temptation-filled modern world. But in long-term investing, it is an indispensable key to success. Condition number 3, you must have mental strength and the courage to make decisions, both buying and selling. This is where knowledge, preparation, courage, and ironclad discipline come together. You may have the formula, the money, and the patience, but at the crucial moment, will you dare to act? The courage to buy when others are afraid. As we've discussed, the best time to buy is when the market is in deep panic. Negative news floods the headlines, everyone is pessimistic, and people are desperate to sell at any price. In that moment, even if your rational mind knows it's a golden opportunity, fear will take over. You'll be scared that it could drop further, afraid that this time is different, the economy might really collapse, afraid of losing everything. That fear can paralyze you. Only when you truly understand the asset you're buying, knowledge, have disposable capital that doesn't affect your livelihood, condition number 1, and possess mental strength, will you be able to swim against the tide to buy when the whole world is selling. That's not reckless. It's courage backed by preparation and logic. The courage to sell when others are greedy. On the flip side, when the market is overly euphoric, your portfolio is growing rapidly every day, and everyone around you is bragging about their profits. When experts are painting the most beautiful future scenarios, greed will take over. You'll think, if only I held a bit longer, I could have made more. Or prices will definitely go higher. Selling now means missing out. You fear missing out on more gains. This is when you need steel discipline. Go back to your original plan, the profit targets you set. When the market is overheated and valuations are too high, have the courage to hit sell, lock in your profits, and turn paper gains into real gains. Don't let greed turn your profits into losses when the market inevitably reverses. Because it will. Accepting imperfection. A strong mindset is also reflected in your ability to accept that you will never buy at the exact bottom or sell at the exact top. That's a fantasy. It only exists in textbooks or in rare strokes of luck. Don't beat yourself up if the price drops a bit more after you buy or continues to rise a bit more after you sell. Instead, set reasonable buying zones and realistic profit targets. For example, when the price drops 40 to 50% from its recent peak, it's a potential buying zone. When your profit reaches 100% or the PE ratio exceeds your acceptable threshold, that's a signal to sell. As long as you follow your strategy and earn solid long-term returns, that's success. Absolutely avoid these two deadly traps. Never go all in. Never pour all your assets into a single stock, real estate project, or cryptocurrency, no matter how confident you are. Always diversify, even if it's just 3 to 5 good assets, to minimize risk. Don't put all your eggs in one basket. Never invest with borrowed money, especially not with margin loans from brokerages, with high interest rates, or from shady lenders, hoping to make a big score or get rich fast. This is no longer investing, it's gambling. And the risk of losing everything and ending up deep in debt is massive. The psychological pressure from borrowing will destroy your ability to make rational decisions. Only invest with your own money, money you can afford to lose. In summary, to succeed with what may seem like a simple investment formula, you need a solid foundation from your main job, extraordinary patience to wait and hold, a strong mindset and discipline to go against the crowd and make the right decisions at key moments. If you're missing any one of these 3 elements, the formula becomes useless. Conclusion: a journey of 1,000 miles begins with a single step. And so we've walked a long journey together. One that condenses the lessons and experiences I've gained over 10 years of youth and money spent in the financial markets. Let's recap the key takeaways. 1. Don't look for gold mines. Focus on the right tools. Gold, stocks, real estate, crypto. These are just tools. Choose one market that feels suitable, safe, legal, and then dig deep into it. 2. Lay the foundation before building the house. Your first priority should be not to lose money. Learn how to avoid scams, research carefully to select quality assets, and understand historical price trends to know where you're standing. 3. Core formula. Buy quality assets at cheap prices during market panic and sell when the market is overheated with excitement. Repeat the cycle. 4. 3 prerequisites for success. A stable income from your main job to fund your investment and stay calm. Extraordinary patience to wait for opportunities and hold your positions. A strong and disciplined mindset to dare to buy in fear, sell in greed, and stay away from all-in and debt. The formula is there. The strategy is clear. But I know the biggest challenge lies in execution. Do you have the determination, the mental toughness, and the patience to stay on this path? What do you think is the biggest challenge you've faced or expect to face as you begin your investment journey? Leave a comment below to share your thoughts, experiences, or any questions you may have. I'd love to read them, and we can learn from each other. If you found the insights in this video truly helpful and valuable, don't hesitate to hit that like button. It really motivates me. Share this video with your friends and family who might also need this knowledge. And most importantly, if you haven't subscribed yet, hit that subscribe button and tap the bell icon to make sure you don't miss future videos. I'll be sharing real-world investment experiences and deeper analysis very soon. Once again, thank you for watching until the end. Wishing you clarity, smart investing, and a future where you reach all your financial goals. Take care and see you next time.